Hi everyone, Adrian here from Oaktree Financial. This week I want to talk to you about redundancy and specifically voluntary redundancies. As we all know, the banks, among others, have announced and are proceeding with a significant amount of voluntary redundancies. Over the past 20 years of my career, as being both a tax advisor and financial advisor, I've worked with companies and their staff through voluntary redundancies. From large pharma and multinationals right down to the local shop. And each of those cases, the ultimate question asked by the employee is always, is this right for me? In all voluntary redundancy situations, the individual circumstances need to be taken into account as to whether taking a voluntary redundancy is right for you or not. Those factors are going to differ in each and every case. As I said, over my 20 years of dealing with voluntary redundancies, I've yet to come across the exact same situation twice. I'm not here to talk to you about the jargon of a redundancy. In most cases, the employer will have employed a firm like ours to come in and work out the redundancy amount for you. What I want to talk to you about is in relation to just before you leave and just after you leave your employment. Firstly, make sure you know what your pension is worth. Your redundancy calculations might include what is known as an increased exemption of about €10,000. Whereby you are waiving your right to a tax-free lump sum in the future. But be careful on this one. While it might be a case on one hand of one in the hand is worth two in the bush, it's not exactly true. We recently worked on a case where our client took a redundancy a few years back and through bad advice accepted the 10,000 extra. However, a couple of years later, when it came to taking the pension from the company, they were not able to take any tax-free lump sum, which is usually 25% of the fund, as they'd already waived that right. For them, given that their pension was over 500,000, this cost about €115,000. Unfortunately, there's been a huge amount of misadvice in this area. Secondly, once you do take your redundancy, it's important to look at what you're going to do with your cash. Most of us would immediately think of a holiday, but as we're not going to be going anywhere for a while, I think we need to bank that one. What a lot of people do is use that lump sum wrongly and miss huge opportunities to grow that money for them. For example, if you got a lump sum of 50,000, you could either use it to pay down your mortgage, which might be costing you less than 3% interest each year, or you could invest it where you might expect to get between 4 and 6% each year. What would you do? If it was me, I would invest. If I use the money to clear down some of my mortgage, I am not reducing the monthly repayment amount in most cases. I am merely cutting the term of the mortgage. So now I've used all my money. What happens if I become ill or unable to work? By keeping the money and investing it, you're affording yourself an opportunity to have reserves built up for that rainy day. So if you are facing that voluntary redundancy conundrum, make sure to take the right advice. Talk to us here at Oaktree Financial Services, phone us on 025 30588 or book a chat with us at oaktreefinancial.ie. Thanks very much.